years, the Eurozone benefited from a strong goods trade surplus. It reflected a competitive export environment and it supported economic growth. But those days are increasingly under pressure. The Eurozone's growth model relied on exporting manufacturing goods while importing relatively cheap energy and profiting from other relatively cheap inputs. But that balance seems to have been disrupted. We see that the energy shocks have pushed up costs permanently, and at the same time, global competition has intensified. China is now a key structural challenge to European growth. Chinese firms have rapidly moved up the value chain and are gaining market share in sectors that are central to Europe's exports. Think of machinery and transport equipment, chemicals, and the pharmaceutical sector, for example. And as a result, export growth has been weakening while imports from China continue to rise. And at the same time, geopolitical tensions are making trade flows more volatile, less predictable, and higher defense spending is also likely to lift imports further. All of this points to a goods trade surplus that is structurally lower and more unstable than in the past. And while some rebalancing can of course be healthy, in this case it more reflects pressure on Europe's competitiveness. And unless that improves, European exports will play a smaller role in driving economic growth.